Hello traders, so in this lesson, we're going to cover high probability liquidity runs. So by now, everybody knows what a liquidity run and a liquidity sweep is. So for the purpose of this lesson, we're going to mainly focus on our liquidity run, but here's a recap. So we're in an uptrend, as you can see by the green color. You can see you have a swing high. And once that swing high is crossed and price continues to the upside, this would be your liquidity run. Well, in this case, we're in an uptrend and you have your swing low. This swing low, when it's attacked, you're more than likely anticipating a liquidity sweep. And once that liquidity sweep occurs, you can target your swing high for a liquidity run. And why did that occur? Because your liquidity sweep occurred first. So to keep it simple, if you're in a bearish trend, let's use common sense. If you are in a bearish trend and you are targeting this swing right here, this swing high, what do you anticipate to happen here? You anticipate price to come up for your liquidity sweep and continue the bearish trend. Why? Because this is a bearish trend. Now again, you could get a reversal, but even if you do get a reversal, you're more than likely to get a break of structure and price coming back inside of the range for internal liquidity to change character. So either way, we're coming back inside of the range. Now, what do you anticipate if you're targeting this swing? What do you anticipate? You anticipate a liquidity run. Now let's take this a step further. So this is something to keep in mind. When trading and looking for your liquidity sweep or liquidity run, the main thing you need to pay attention to is your structure. What type of structure? Is price moving in a supply and demand structure where price is breaking structure and retracing back deep inside the range? Breaking structure, retracing deep back inside the range, and so on, so on. Or is price doing this? Or is price breaking structure and rejecting right from the previous high, breaking structure, rejecting right from the previous high, and so on, so on. So what is the difference between these two structures? The difference here is this one would be more of a supply and demand structure where price is retracing deep and rejecting from, in this case, in a downtrend, it's rejecting from your supply levels, be your supply order blocks or your premium levels when it comes to your fib. Well, in this case, price is rejecting from your peak, which would be your support and resistance. It's rejecting from a high rejection level. It's not retracing back inside the range. So this is something you want to pay attention to. And why is this something you would want to pay attention to? Because if you look at your supply and demand structure, every time price breaks structure, here, price still retraces back inside of the range to grab more internal liquidity. Price breaks structure to the opposite end and still retraces back for more liquidity. So when you're looking for a liquidity run, you have a higher possibility when it comes to your support and resistance market for when price breaking structure, price not immediately coming back inside of the range, price giving you that actual run. So when you're looking for liquidity runs, this is what you want to look for. You want to mainly trade in your support and resistance structure. And now again, we're going to take it deeper and how to trade liquidity runs in a supply and demand structure. But to keep it simple, and if you're a beginner, you want to mainly look for a support and resistance structure. Before you proceed, please make sure you like the video and leave a comment. This video is completely unmonetized to make sure you guys are not interrupted by ads. So let's take a look at this example. We're not just going to trade any single liquidity run. We're looking for a high probability. So what do you have here? We have our swing low. Again, we're not just targeting this swing low. Once price crosses this level, we're automatically in the trade. That wouldn't make sense. What we're waiting for is more context. As you can see here, price is approaching this level, but rejects. So building context, what happened here? Price rejected from a demand level. That means buy orders were inserted. So what does that tell us? If price does not continue to the bull side and does not change character, that means the buy orders in that area were not enough. Again, the buy orders in the demand area were not enough. So when price does come back to revisit this level, price will more than likely continue to the bearish side, which would be our liquidity run. So let's take a look at this example. So we were in a bullish trend up to this point, but look what happened here. Let's get a read on structure. Price made a low, made a high, then made a lower low. So what does this lower low indicate? This lower low indicates that there was a break of structure. That means that the trend might change to the bear side. So for now, we are bearish. So this is our swing high, and this is our swing low. So what do we anticipate if price attacks our swing high? What if price gets up here? What can we anticipate since it's a bearish trend? If you guess sweep, then you are correct. We can anticipate a liquidity sweep. And what happens if price approaches this level? Of course, you anticipate a liquidity run. But the difference here is we're targeting specific liquidity runs. We're not looking at just any simple liquidity run. The name of this video is high probability. So we're going to look for high probability liquidity runs. Let's build context. So what do we have here? We have a rejection. What does this rejection tell us? It's all about picking up clues. This rejection is from a demand level. So an easier way to interpret this would be, let's say you have a huge dollar sign right here. If this dollar sign, if the amount of orders in this demand zone is big enough, then price would break structure and continue to the upside. Why? Because there would be a lot of buy orders. Now, if price fails and does not reach this level and comes back, that means the dollar sign was not as big. There was not that many buy orders, and it would be a small buy order. So let's see. So price failed to break structure. So now what are we waiting for? We're waiting for our liquidity run. So once price gets below this level, we can get in a short. So what happened here? You have another rejection from our demand level. The more rejections, the better. Why? Because the more rejections, the more it proves that there's less and less money in this demand zone. There's less and less buy orders in this zone. So a break to the downside is inevitable if price crosses this level. So what do we have in our favor? We have the trend in our favor. That's one. We have our weakened demand zone in our level, in our favor, and our second tap. So we had our first tap and we had our second tap. So all these things are in our favor. So before you enter a trade, you need to build a scenario. The more context you have, the better. Let's see if price breaks structure to the upside. If it doesn't, this trade is still on. So price did not break structure to the upside. That means this demand level is extremely weak, and the dollar amount here is almost non-existent. So once price gets below this level, we can get in a trade. So now, once price got below this level, now you are in a trade. And where would your stop loss be? You would look at the approachment. You would look at how price approached your liquidity. So first thing you want to look at is a rejection level. So look at this rejection level. Let's make it red and let's make it really dark so you guys can see. Look at this rejection level. Price rejected at this level before dropping down. So what does this tell us? When price breaks liquidity, a lot of time it retraces for a mild retracement to break down. So more than likely you will get a bounce here. So you could always take a bounce trade here, or you could enter once price crosses the liquidity. So where would your stop loss be? Your stop loss would be above this level, somewhere right here. Just because you anticipate the rejection and you want to keep in mind of the spread. So you can take your 1-to-1 trade and you can take your 2-to-1 trade as your TP. So you go break even once your 1-to-1 is done and you can target your 2-to-1. and you had your rejection right here. And if you were to trade rejection, when a lot of times price just dumps down, doesn't even give you this chance of a retracement. But if it does, obviously you'll get a better risk to reward. It'll be something like this. So you could be patient and wait for a trade right here, or you could just trade the momentum. Here you have your swing highs. Once that swing high is broken, you would anticipate price to continue. But if you are in a supply and demand structure, price can always come back down. Once price comes back down and takes your previous swing low, you're starting to target your new swing high. And what happens here once price attacks your new swing high? You will more than likely anticipate a continuation. Why? Because your previous swing low was taken and a sweep occurred. So what do we have here? Price was in a bullish trend. And then you had a break of structure, but price retraced back inside of the range. So you can guess where we're going with this. So the fact that price came back inside the range, we can anticipate this as a sweep. This was our liquidity sweep. So now that this is our liquidity sweep, let's target that high. And what can we anticipate to happen in this high? Probability wise, we'll more than likely get a liquidity run. More than likely get a liquidity run. Now again, you could get an external to an external. You could get a external to external, but at the same time, it's more than likely that price will continue to the upside following our initial trend, since this was our liquidity sweep. So this would be a high probability liquidity run. Let's add context. What do we have here? We have a rejection from a supply level. We have a rejection. So once price crosses this level, we can get in a long position now that we have our context. So what is in our favor? What's in our favor here is our trend, our sweep, and our used up supply level. So once price breaks structure, you're in the trade. And where would your stop loss be? You want to look again at a high rejection level. So where do you see that there was a high rejection level? You can see that there was a high rejection level right here. This is somewhere where price stopped before reaching your level, before the expansion, before attacking our liquidity. Price had turbulence right here. And before that, price had turbulence here and had turbulence here. So this would be our stop loss. And let's aim for a 2-to-1. Obviously, after our 1-to-1, we're going to break even. So the best approach for a liquidity run entry based off statistics would be this. Now I was kind of reluctant on sharing this because I do share this on my website, but for the 100K purpose. So let's say you have a bearish trend. What you want to see is you want to see a stop hunt, price breaking out of the range, coming back inside of the range, but not retracing all the way deep, retracing somewhere below the equilibrium, and then dropping. This is your best liquidity run entry, where your entry would be right here. Why is this your best entry? Because one, you have your direction in your favor. You have the direction of the market in your favor. You have the stop hunt in your favor. You have a break to the low side and a failure to continue on this side. And you have your failed demand zone. So once you have that failed demand zone as well, this is your perfect entry. So let's take a look at this example. So you are in a bearish trend and this is your stop hunt / your liquidity sweep. And this is your low. So like I said previously, the fact that price did not retrace deep in your premium zone, the fact that price is not retracing deep in your premium zone, you can wait for your high probability liquidity run. And your entry would be right here. Let's see. Price still did not retrace deep. And what do you have here? Price has been rejecting from this level. And what is this level? This is our false demand. Price rejected once, twice, now 3 times. So when price does get below this level, you'll more than likely get a fair liquidity run. So where would our stop loss be? Look at our previous rejection point. Price rejected at this level before coming down. And if you pull it out, price rejected all the way up to here. So our stop loss would be right here, a little bit above. And we are looking for our 2 to 1. Hope you guys enjoyed this lesson. Make sure you like, share, and subscribe, and make sure you leave a comment. What video do you guys want next?